everyone. Welcome to Ask the PLANMAN. Everything you want to know about insurance, finance, and more, but we're afraid to ask. I'm your host, Bruce Weinstein, and I have a belief that every one of us should have a plan. Whether it's a financial plan, a retirement plan, a business plan, a fitness plan, even a travel plan. Each week, I bring you guests to talk about the different areas to help you maximize your plans. Today, I'm joined by a dear friend, Peter Passalacqua, who's a certified financial planning practitioner and the owner of Frontier Planning. Pete has over almost 30 years now, right? 25 years plus experience in financial planning space. And I've asked Pete to come on to talk about a variety of topics to help you understand what financial planning is all about. So Pete, welcome to Ask the PLANMAN. Let me get you started. I want to dive in and talk about the differences for people and understanding in our space between a fee-based advisor and a fee-only advisor.
Okay. Well, thanks for having me on, Bruce. And we've known each other a long time, so this is a great opportunity for me, and I appreciate the opportunity. So, yeah, I mean, there's a lot of definitions and terms in our industry, too, that you hear, fee-based versus fee-only. It's very technical, but when you're talking about fee-only, you're talking about someone who strictly receives compensation from financial planning and asset management. And so there are no other incidental forms of compensation, perhaps a life insurance product or a commissionable product that may be sold. So it's a very defined area, and you may see that logo or designation on their website or on their card. So that would be the fee only, and then fee based is a more broad term. Of course, it includes those first two areas, fees for financial planning and asset management, but that person could venture out into some other areas. For example, life insurance. They could venture into annuity products that are possibly commissionable, or other commissionable products like mutual funds that have a commission. So in some ways, a fee-based advisor can handle more implementation of a financial plan versus a fee-only. But some folks want a very narrow version of financial planning that is strictly on the advice and asset management side.
Right.
So that's how I would explain those two categories.
So let's see if I can break it down for my listener a little bit. So if you think about the major brokerage firms, right, the Merrill Lynch's out there, they tend to be, they've shifted. From when I started with Merrill Lynch in 1986, it was strictly commission. There were no fees, or you didn't do planning work. We didn't do any of that kind of stuff in the mainstream yet. So you and I came up through the evolution, but the movement that really became advice-driven, fee-driven. So the standard days of stockbrokers were paid transactions, and then they started to get into fee-based asset management. They weren't necessarily doing planning work like you and I, but they went away from the traditional commission and said, instead of getting a 4% commission or an 8% commission back in the day, we're going to charge you 1% to manage your money, Pete. And so what they basically did is no different than Microsoft and Netflix and everybody else, is they systematically created a recurring revenue stream. And so getting away from a commission transaction, well, now there's a potential conflict of interest. If Pete's calling me to buy and sell Microsoft stock, Pete's getting a commission. Did he really think it was in my best interest to sell the stock that day? Or was he looking to generate a commission? Oh, by the way, it's the 28th of the month, and Pete always seems to call me around the 30th, right? So it took away that conflict of interest. Then you put the wrapper of planning, where you charge a certified financial planner can charge either a flat rate or an hourly rate to do and conduct planning work. You're a hybrid in a sense, right? You do asset management and planning. I have colleagues that I went to school with that are strictly planners. They don't implement asset management. They don't want to get involved in the asset management. They'll give recommendations of where to go, what to do, who to use, but they just charge fees for planning. So some people want that. because they want to manage their own money. They don't trust other people out there maybe with their money, or they're if you and I left the business, we might want a planner for an objective advice. I might consult with you, you'll consult with me, but I don't need to pay you to manage my money per se. I might be able to do it on my own. So, but I still want to have an opinion and pay you for your time, right? So they exist. And so you have your registered investment advisor. They tend to do asset management for fee. They have different licenses. They don't necessarily trade, stocks and bonds for, commissions anymore. And they have a fee to manage money. Some do plans, some don't. A certified financial planner like Pete is capable of charging in a number of different ways for his time and his work planning asset management. So I don't know how you're doing these days. Are you doing anything in a commission sense, or to what I would be to be a fee-based versus fee only? How would you describe your practice?
Yeah, so I mean, I wear a few different hats, like most people are in our industry. So I do a lot of Frontier Financial Planning and Capital Management is an RIA, Registered Investment Advisor, registered with the state of New Jersey. I'm also I'm duly registered. I am also registered with a broker dealer. The Investment Center is my broker dealer, and they also have an investment advisory arm, an RIA, called Creative Financial Design. So it gets kind of complicated, but I wear different hats. So yes, I do work. I do work I can strictly work as a financial planner and prepare a financial plan for a client, and that could be the end of it. They just want a direction. They want to know where they stand. And as you know, Bruce, people come to us, they're kind of thinking about winding down their jobs or maybe taking a package, or so they want to know where they stand. So people come to me, and then other folks come to me and they say, well, I want that financial plan, but I also want you to help me implement parts of that financial plan. So there I may wear a hat where I may introduce an annuity product that pays a commission to me. I may do asset management work for clients. And so, yeah, I'm wearing different hats, and it's all about the client and the client's needs and being able to facilitate and take care of those needs. From my perspective is how I approach it.
Well, I deem it, we were pretty much always fee based, and we would explain to the client, and certainly it's big on disclosure of how compensation is derived, and you give material that has disclosures that are registered and oversaw it and have to be approved. So you can offer different things for the different client potential there, so that you can meet their needs and they don't have to go find somebody else. The biggest thing for you and I, what we've collaborated, we worked on clients together, we did seminars back in the day together, is I found, I won't speak for you, you could yay or nay it, is I lead with the planning, because the planning's going to drive the direction. And as we describe on Ask the PLANMAN, it's all about the SWOT, is strengths, weaknesses, opportunities, and threats. And so the planning process breaks down a client's SWOT, and we discuss their strengths, we discuss their weaknesses, we show them the opportunities, and certainly we want to do things around the threats. So in the insurance world where I'm sitting these days, everything around insurance is to protect a threat. It's an unknown that's potentially going to come up in your life. And so, you could all choke on insurance in that space, but there's insurance for everything, right? And so from the investment side, you got to build a level of trust to be able to get somebody to allow you to manage their money and their future. And so obviously there's family that might come in, or referral is always a high level, but when you're dealing with the public, and certainly you and I have had our fair share of attracting strangers to us, like that's how we made our businesses, right? We didn't get it from family and friends, is you've got to demonstrate a level of trust. And in the networking world, it's, people know, like, and trust, and people don't care how much you know until they know how much you care. So you got to get into the weeds with them and demonstrate your knowledge, your expertise, but also hold their hand that you're listening. And so for me, to bring this to, a point for you, is the planning process that you and I embarked on usually entailed anywhere from 3 to 6 meetings. at 1 to 2 hours, and you've been with me, you know they go more than 2 hours.
Yeah,
You
two,
know,
two plus hours for you.
yeah, we're plus plus, but no additional charge. And so, in doing so, you're breaking these things down. You're showing the clients how much you're paying attention to detail and listening. And by the end of it, the asking for implementation part is usually self-fulfilling. Do you agree? And yeah, so is you pretty much still running your practice the same way?
Yes, absolutely. I mean, well, if you remember back in the day, it was introduced as the consultative selling process. I think was how it was explained to us back in 1917 when we started in the business. Well, when
I
I
just
started,
got out of third grade in
you
1917.
so yeah, I mean, and sometimes people will come to me and they'll say, I just want a financial plan. That's all I want. I don't want anything else. And I'll take them through that financial plan, and then not always, but sometimes at the end of that, they're like, well, who understands my situation better than Peter, who's looked at me, who's spent the time with me, and who gets what I'm trying to accomplish, and you're showing the client this is the financial plan, these are the analytics, and this is the recommendation based on those analytics. You know, what rate of return do I need? Okay, showing them a cash flow if one of them dies, for example, right? So you're showing them this stuff, and for the first time, they're seeing their financial life on paper, and they're looking at the information, and they're learning about it, they're understanding it, and they're like, oh, okay. So you're tying the advice to I'm sorry, you're tying the financial plan, the situation to the recommendation. You can see how those things fit together, and okay, that makes sense to me. Versus, well, here's this shiny thing you should look to purchase because it's really wonderful.
So
Which
I
is
always say I have nothing to sell, just problems to solve. And so the plan identifies the problems. These are your strengths over here, Pete. You're doing great with this. We need to clean this up. And so the projections, the cash flow analysis, the rates of returns, the uh, all those components then back into, well, this is why Pete's recommending this portfolio risk, because that's what's matching all you need to do. Somebody who's selling a stock or a mutual fund and selling performance doesn't necessarily, again, I'm going to use some jargon terms Pete and I have used over the years, we're financial doctors. And so if somebody's giving you investment advice or a recommendation without really understanding a needs analysis, it's malpractice. It's like you going to your doctor saying my arm hurts, and they give you some medication without really knowing, well, maybe it's, there's a reason you have a chest pain or a blockage or whatever, so, your doctor's gonna say, let's run some tests, right? Pete, I want you to do blood work, go pee in the cup, let's get an MRI. Well, that's what a financial plan is, isn't it? It's doing an evaluation.
That's right. And there's two parts of a financial plan, as you know, Bruce. There's the quantitative aspects of a financial plan, like my net worth, my what I spend on entertainment. But more importantly is the qualitative information that comes from the client. How do I feel about risk? How do I handle downturns in the economy or the market? So really, I think a perfect financial planner or plan is to put those things together, right? The qualitative and the quantitative. And like you said, problem solving, okay? What ideas? Anyone can crunch numbers. I could go on the internet, I could find 20 websites that can crunch numbers for me. But that's nothing. What do you do with that information? What is the client telling you about their risk tolerance? How do they feel about retiring? What about their health? Okay, right? You do life insurance. You want to know about their health, for example, right? But if I just apply for life insurance, right, I could step into a hornet's nest, all right, if I haven't had a conversation about my health with someone. So I think those are the different aspects that really bring it together.
I was trying to write down a couple things because you brought up some good points. I want to make sure we capture it here. So you mentioned, I got a couple things. So you mentioned you can go on the websites, right? Everybody can crunch a financial plan. And what you and I used to say is, well, what are you going to do with that information? Right? You could say, I could work till I'm 62 and get $50,000 a year, and I just got to go out and make 9%. Okay, now what? How do you go make 9%? Like that, they didn't tell you how to do that. What's the risk involved with making 9%? Oh, by the way, what about your life insurance, your Medicare, your long-term care, your estate plan, your kids' special needs trust? Like, did they talk about that on that website? No, they just crunch numbers. So the implementation piece of it, it's my 36 years, it's your 30 plus years. Like, you're getting more. People have to understand what they're buying. It's like going to a mechanic. You want the guy who's fresh out of school. You want the guy who's been doing it 30 years, that's seen cars and all kinds of different situations to kind of quickly diagnose the problem and give you the, you know what, it's just a spark plug. Okay. I'm thinking my car needs, to be trashed. But the other piece, when you talked about quantitative and qualitative, is, and this is an old acronym you and I have thrown around for many years, is Woody Woofy, right? There you go. Blast from the past, right? What do you want for yourself? So we talk about Woody Woofy all the time. So again, numbers are numbers, but then it's massaging and educating and saying, look, I've counseled 1,000 different couples. Would you like to know what their priorities are? Because it's probably close to yours, right? And so it's the roadmap is different for every person, but the infrastructure is pretty much the same. You and I both know people are going to die, right? Every one of us human being knows at some point we're going to die. How come everybody in the world doesn't own life insurance? Is it a guaranteed bet? Yeah, death and taxes, right? So, but people don't feel they need it. They don't want to waste the money on it. And my point is to push on the life insurance, but there's things you know, there's things you don't know. And the whole part of the planning is to uncover the things you don't know and to help guide people into that. Again, we're back to the SWOT, right? So the Woody Woofy is now, let's call it the intangible side, because it's, again, you're throwing a lot of our jargons out there again. It's needs versus wants, right? You and I want to tie in budget. We're gonna start to segue over to the budget side of this. But what's the core piece of budget? It's needs versus wants. It's committed versus discretionary, right? So at its core, as a human being, we all have basic needs, and then we have wants. So your Woody Woofy, what do you want for yourself? Not what you need for yourself. I don't know what that acronym is. What Wooden Woofy is, well, what do I need? I need a roof over my head. I need a car that drives, and I need 3 squares a day, right? Well, you can get that in a lot of different places. You may not like it, right? You get 3 meals in the state pen, and there's a roof over your head. But that's not what people's ambition is, right? So from the Woody Woofy standpoint and the wants and the needs, the plan itself, and this is let's segue into the budget conversation of why is a budget so important. It's the gasoline in the car. The plan is the car. The plan is the engine. Pete and I are the navigators to get you through the trip, but you got to have fuel, right? You got to, well, electric car maybe these days, but you got to plug in whatever it is, right? You got to have some juice, right? So let's talk about the budget and that driving force. So let's tie it in. Let's break down committed, discretionary, and all that, and talk about the importance of budgets.
Okay, so as the audience may know, there are 6 areas of financial planning. Okay, and one of those areas is budgeting and cash flow. And to me, in some ways it's the weediest part of talking to a client, right? You're getting into the weeds of how they spend money, where they spend money. And that's always kind of tricky, as you probably know, Bruce.
It's probably one of the biggest roadblocks of hurdles to get our clients to do, right, Pete?
It's a nightmare.
It's like, I'll give you all my money, just don't ask me for a budget.
And when we ask clients for budgets, it's a big challenge for most of them, because they look at you like, I don't know, what do you want from me? Like, and how do we spend money? We don't spend money in the same way every month. So maybe in December, I spend a lot of money on gifts. Maybe in the summer, I travel more. So it's hard to capture budgets. There was a gentleman at our old firm who, remember, if you recall, he had the 6-part accordion part profile, we used to call it. And he would ask people for budgets, what if budgets. What if your wife dies? What if you die? What if you're retired? And those people, inevitably 96% of the people he would pull out that accordion to would never come back again, because they're like, oh my goodness. I don't know if you remember that story.
Who
But
did that?
anyway, so the budget, yeah, I think the budget is very much, what is it, some people say, what does it cost to be you? Okay. I do things, I have certain hobbies. Maybe I have 5 kids. Maybe you have no kids. Okay. So what does it cost to be you? And it's the bar that we truly set for ourselves, right? I want my bar up here. I like driving Porsches. I don't mind driving a Toyota. My budget's lower down here. So it's all over the place. It's very much about your personality. Maybe it's also about where you live, right? I live in New Jersey. It's very expensive. Someone might live in North Dakota. So the budget is very much, I think of it as your handprint of who you are and how you live. So that's what we're trying to understand in the beginning is, what does it cost to be you? And that leads into the goals of the plan, and what you're trying to accomplish. So that's the first piece.
So we've used the building a house analogy and the foundation of the house, that you don't put a roof on a house first. You got to lay the foundation, pour the concrete, and then build up. And so the way we've always described this to clients is the foundation starts with a positive cash flow and understanding where your money's going, because ultimately, if you want to reach certain goals, you got to take it from your cash flow. It's got to come from somewhere. And so when people are in debt, when people have credit cards and they're servicing that and they're living a lifestyle above their means and they wonder why they can't save and why they can't get ahead, well, that's where you and I do the plastic surgery. We used to have jars in our offices and we'd cut up people's credit cards. We called it plastic surgery. So we would kind of say this, folks, is if you're in the ER, you had an accident, you got a busted leg, right? The bone's sticking out, not to be graphically gory here, the bone's sticking out, and I got to get you into surgery to repair and fix your leg, but you're bleeding profusely. I can't do any surgery till I stop that bleeding. And if you're bleeding money, I can't fix your retirement plan, right? If you're, so it doesn't matter whether you make $20,000 a year, $200,000 a year, $2 million a year, your money's getting spent somehow, some way. And somebody, we've had instructors, right, that will tell us their minimum client size is 10 million and above, and he will not take them on until he gets a budget from them. And you say, well, who cares if somebody has $10 million or more? Well, because a $10 million net worth, $100 million net worth, a $100 million income earner is still going to piss their money away if they're not responsible, right? Helicopters, and they're just buying bigger cars and bigger toys. How many yachts do you need there, Gordy Gecko? So you need to know where the money's going, because if you say, look, I want to start saving for my kids' college, I want to save for my daughter's wedding, I have to take, I want to have this in retirement. So your Woody Woofy is going to drive that engine. Well, Pete, how are you going to fund it now? The plan's going to say, Pete, you need to save $2,000 a month at a 7% rate of return, and you can retire in 7 years. I don't have $2,000 a month, Bruce. Okay, well, you're going to have to keep working then, right? So you can't hit your goal if you don't know where your budget is. And we just went through an exercise. My buddy John and I are working with, a couple down here, and they're making good money. And I took them through the exercise. And he's like, well, I don't have a budget. And he's my age. And I'm like, look, get your checkbook out, Get your credit card statements out, start tracking where that money's going. You're spending it somewhere. Money does one of two things, right, Pete? It's either spent or it's saved. There's no mystery, right? And then the other exercise you and I do is called take-home pay, right? Remember those exercises? Like, it's not what you make, it's what you keep. So I got to pay taxes. I'm funding my 401k. I'm paying FICA. What am I taking home? Because that's what I'm living off of now. And then I have to pay my rent, my mortgage, my car payment. I got to save for college. I got to save for retirement. What's left, right? And so when people look at their budgets in retirement, we work off of take-home pay, because I don't need to gross up your income for a 401k contribution in retirement. Your tax brackets are going to be lower, right? You're not going to pay FICA anymore. So we work off of those numbers. So I'm sorry, I kind of cut you off there a little bit. So let's talk more plastic surgery and some of the people that we've helped to work with, not name specific, but where have you seen some challenging cash flow budgety? Oh, I didn't finish my guy. So sorry. So my guy, I made him go through all of this stuff, and the long and short of it, when we got back together after, and folks, what we usually do is tell you, monitor your expenses, keep a notepad for the next 30 to 60 days and write down everything you're spending. I don't care if you're getting a bagel and a cup of coffee every morning. It's 95 cents. It's $1.95. You're picking up a newspaper. Write it down. If you don't have a budget right now, your next step of action is to start tracking where your money's going and get off of the credit card, overspend, and get tighter on your budget. So this client, to wrap that up, did the exercise, was aghast at how much money he was spending, and very apologetic. I'm like, you don't apologize to me. If you want, you've seen my taglines. You always get what you always gotten. If you always do what you've always done. If you want to make change, you got to stop doing the things that got you derailed thus far, and you got to change the pattern, right?
Absolutely. So that's a great example. And I just came back from our conference at our broker dealer, and the gentleman who started that firm, he does a lot of planning, and he said statistically people don't know where 20% of their money goes. They just have no idea. So as you know, sometimes we'll put a fudge number in the plan because we just don't know where that money goes. So that's one point. The other thing I'll say is complexity. So we spend money in different ways. We have a credit card over here. Oh, I use this credit card for miles. I use this for shopping at the grocery store. I get points, and that's the recipe for disaster, because I have all these cards and I have 3 checking accounts, and right, it's like, how do you tie all that together? Do you spend a lot of time? No, we don't spend any time tying it together. So the KISS concept, keep it simple. I'll leave the last S for
silly. Keep it simple, silly.
A lot of it is around simplicity. Cash or ATM cards are great. You may need a credit card for the internet. Fine, you need one because you're worried about security. But so we've worked a lot with budgets, and if you're not going to spend a lot of time budgeting, then you need to have a good, compact, simple way that you spend money, right? And then you're not sitting there trying to track down, where'd my money go and how did I spend it, and from an advisor standpoint and from a client perspective, the key thing is, what's my discretionary income? How do I create discretionary income? You said before, maybe somebody needs to save $2,000 a month. All right, so maybe you and I say, maybe the clients, and we agree that they can only save $500 a month. So let's do it, okay? Let's start that baby step, and let's start saving that $500 a month. Oh, by the way, systematically, automatically, and sometimes I'll do bi-monthlies. So somebody maybe get paid bi-monthly. And let's start saving that money, and let's see how you do. And people are like, hey, you know what? That's not that hard. I'm doing it. I was on the phone today. I was on a virtual with a young lady today. She's saving $600 a month. Before I started working with her, she was saving nothing a month, and now she's saving $600 a month. And she's like, "This is easy," and I'm like, Wow, that's cool. It's like
And that
you're
successful
teaching and you're
snowball.
doing it. So these are tools, that we implement, and then, you know, and then you work. Your budget is based on paying yourself first, right? We hear that term a lot, but paying yourself first. So you're saving in your 401k, you're saving systematically, and spend the rest. I always say to clients, if your cash flow is tight, you don't have a lot of money, but you're saving and doing the things you need to do, that's actually perfect. But when you have a lot of free cash flow and you're not sure what to do and how to spend it, you know, that's where people get into trouble. Of course, human nature is, I want to live up to my lifestyle that I can afford, right? So, when I was making 80,000, I was here, then it was 100, now it's 150,
Well,
right?
your your
That's what happened.
lifestyle your lifestyle expands and contracts around your income. So the more you
It
make,
should.
most people just start spending more. They don't say, "Well, I've been used to living on 50, now I'm making 80. Let me bank that 30." It's no. It's like let me get a new Mercedes. I made a note. I lost it twice, so I wrote it down the third time when it came back. It sucks getting old. Uh, Regarding the budget and the exercise we put people through, let's be pretty blatant and blunt here. You and I can do the budget for them. It's not that hard to figure out where their money's going, but it doesn't do the client any good without taking ownership of the process. And so I want to drive that point home, Pete, because you and I know how to look at people's books. Again, money only goes two places. It's either spent or it's saved. Once you show me your paycheck, I know exactly where your money's going. And if it ain't in the bank, you're spending it. It's that simple, right? And so the whole purpose of this, folks, is the exercise is to help educate you and make you self-aware of what's happening. Because Pete and I can't fix you. You have to fix yourself. We'll guide you. And it goes back to the doctor and the medication, right? You go in for a prescription. The doctor gives you an evaluation. They give you a diagnosis. And they say, here's the prescription. Now it's up to you to go to the pharmacy, not only fill the prescription, but actually swallow the medication. And that's the implementation. So you and I can give a million outstanding recommendations to all our clients for 40 years. If they don't swallow the pill, they're never going to get what they saw.
Not gonna get the benefits of what you're trying to do with them. And how many times have we've done financial plans where the client said they wanted to have implementation, but they didn't implement the plan, and then it's like, well, you just actually spent a lot of time, you took a lot of our time, and maybe you paid us. Hopefully, you paid the financial planner, but really, you had a false start. You wanted to do it, but you didn't do it, and that is the hardest thing, because that's where the rubber meets the road. It's like, okay, let's we design this program, you understand it, you agree with it, now let's go ahead and do it, right? And just like that sometimes is is where it just all comes crashing down for people.
Psychologically, another thing we've used is what's the difference between fee and free, right? The R. And I can give you all the free advice in the world, and it's going to be worth to you what you paid for it. But when people write a check, they come to your meetings, they're going to listen to what you're saying and recommending because they've got skin in the game. They've paid you, right? And so the process and the exercise is to help them help themselves. And if they don't implement and they don't follow through, I mean, that's on them. If they paid their money, you pay your nickel and you get what you get. But what you and I have also made efforts on is asking permission to hold them accountable, because people want to be held accountable. They're distractions in life, right? You're distracted, I'm distracted, got a million things. And so their money management, their budgets, whatever it is, like they lose track. Okay, we're all human, right? But you're empowering Pete to hold you accountable. You paid him a fee. You're meeting with him quarterly or semi-annually. You're paying him a retainer every year. Why? Because he's holding you accountable. He's making sure you're doing the things you need to do. right? Why do you go to the dentist every 6 months? Why do you go see your doctor for an annual exam? Okay, it's no different here. Is you want to have that relationship with somebody, fee-based or otherwise, that you count on. You trust their counsel. They seem to know what they're doing and implementing for you. It makes sense. And folks, if it's not, get somebody else, right? Again, one of my many lines is don't go it alone. There's no reason to try this on your own unless you've already been a trained, experienced person from our space. Pete can go it alone. I guarantee Pete, there's certain gaps in Pete's world that he's going to seek out help and advice for as time comes, right? So, we don't all possess everything of knowledge, but I think you and I do a great job covering the majority of the gaps people face in our years of doing this. We could talk for hours on, the stories we've encountered and the characters we've worked with, but let's bring it to a close. Our time is starting to finish up here. I want to thank my guest, Pete Passalacqua, certified financial planner, registered investment advisor. We've been talking about the differences between fee-based, fee-only, and RIAs, and as well as the importance of how the budget will ultimately be the driving force behind most people's successful financial plan. Pete, how can people get a hold of you if they'd like to speak with you more?
Well, they can find us on the web at frontierplanning.com. We're located in New Jersey, and all my contact information is there, so that's easy enough.
And we'll put that in the show notes. And just to be clear, yes, you're based in New Jersey, but like us, you've got clients in many states. So you're not limited jurisdictionally to work with a client just in New Jersey. So anybody in my audience here that's listening wants, to talk with Pete, he can work with you no matter what state you live in. So thank you for that. And again, we'll put Pete's contacts in the show notes. Folks, you've been listening to another episode of Ask the PLANMAN. Today's episode was the differences between fee-based and fee-only advisors and the importance of budgets. Please like, share, subscribe to our podcast channels, our YouTube page. Everything is under Ask the PLANMAN. We'd love to hear from you. We want to hear your questions, your topics of discussion. You can email me personally at bruce@asktheplanman. Visit my website, www.asktheplanman. Call my toll-free number. The call's on me, Pete. You can call me for free, 844-PLANMAN. I got it all covered. If something's out there that I don't have, maybe it's Pinterest or something, I don't know. But I got all the PLANMANs covered. So, ladies and gentlemen, thank you so much for joining us. Remember, if you need some advice, always get it right. Come ask the PLANMAN. I'm your host, Bruce Weinstein. Until next time, don't forget to plan. Thanks again, Pete, for being with us.